Good morning and welcome to today's webcast, Tax Update, Key Changes and Implications for Institutions. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce our presenters for today, Kristine Hoeflin, partner at Moss Adams, and Amy Jessup, senior manager at Moss Adams. With that, I'll turn it over to you, Kristine.
Perfect, thank you. And thanks to all of you for joining us today. As mentioned, I'm Kristine Hoeflin, tax partner heading up our financial institution tax practice. I work with banks from less than 100 million in assets to over 15 billion. And I'm always happy to talk tax planning and strategy with clients at all sizes and stages, as I have been for nearly the last 17 years. So with that background, we're going to jump right to our planning topics for today, as you can see here on your screen. And to kick things off with the smell of fall leaves and election season in the air, we're going to start by taking a look at the presidential candidate tax proposals. So certainly we see a lot and have a lot that we may or may not be able to predict from everything going on in the news. But if we are taking a look at the candidates' tax proposals, we do see that under Trump's proposed plan, there would be no change to the 21% federal tax rate under his plan in the short-term future. His plan does also look at extending the 100% first-year bonus depreciation for fixed asset addition. So those would be items that you could expect him to push for. Under Biden's plan, if we see a change in office and Biden in office, his plan proposes that we would increase the tax rate from 21% to 28%. In addition to that, it proposes a 15% minimum tax on companies reporting more than 100 million of book income. So this second bullet here isn't one that I'd necessarily expect to apply to banks. Where you'd see this more commonly come into play is for companies that have significant research credits, that have significant book income, but are generally bringing their income down, or their taxable income and tax down to zero through the use of credits. So this would put in a 15% minimum tax there. And his plan does reflect an elimination of bonus depreciation. A couple things to keep in mind as we watch things unfold on election evening. One of the things that we saw in 2016 that ultimately led to the Tax Cuts and Jobs Act was an overall red sweep. So we not only had a change in office, we had a Republican in the presidential White House. We also had a red Congress. So House and Senate were both Republican majorities, and that really helped drive the quick passing of the Tax Cuts and Jobs Act. That'll be likewise something that we'll want to keep our eyes on as we look to the election day and the ultimate outcomes, is what the mix not only of who's sitting in the White House, but also what happens with Congress. A number of the questions that have come through with tax planning with clients lately also relate to, well, as we watch the outcomes, what should we think about from a timing perspective? And so if we look at history, as well as what I hear from economists, we probably have still a little bit of time to do some planning. So for example, when we looked at a change in the president in the White House in 2016, we saw that in a rather quick outcome at the end of 2017, the Tax Cuts and Jobs Act was passed, and that was reflective of rate changes that went into play in 2018. So if we followed a similar timeline, if we see a blue sweep and we see a relatively quick movement of Congress to push things forward from a tax standpoint, potentially you would be looking at a change in the White House in 2020 that would drive potentially a passing of law in 2021 that could bring a rate change in 2022. Now, certainly, I wish my crystal ball was better than all of yours, but it's not. So I will just put that out there as a reflection of what we've seen in history, what we're hearing from economists, and as we look at what unfolds on the election outcomes here in the next handful of weeks, some items to be mindful for as you think about how you can plan for your institution and the related potential tax changes that may be coming. In terms of how these would play out, so if we do look at an expectation for a tax rate increase, as a reminder, you have a deferred tax asset on your books. That's a reflection of future tax deductions at the federal and state tax rate. So if we anticipate, say, a 7% increase in the federal tax rate, that would correspond to a revaluation of your deferred tax assets up. So in this simple example, you would say, let's say we have a timing difference of $100,000. Let's pretend an allowance for loan loss. Maybe you add a few zeros there. And that's valued, that value needs to be increased by 7%. That's going to result in a debit to your deferred tax asset and a credit to the P&L. So the revaluation of your deferred tax asset has a benefit that'll impact your P&L. As a reminder, that happens in the period that the enactment occurs. So like we saw in Tax Cuts and Jobs Act, the enactment occurred at the end of 2017. That's when that was recorded through the financial statements, regardless of when the rate change itself actually comes into play. So if we saw similar timing, you would increase the value of your deferred tax asset with the credit through the P&L. And then you would subsequently see the increases in tax expense going forward. Always planning. So if we do see a tax rate change coming through, there's a number of items, both low-hanging fruit and more complex planning that can be done to take advantage of the changes in the rates. So largely what you're working to do is save certain deductions for the time frames when they would get more valuable deduction rate. And so if we were going from a 21% benefit of a deduction to a 28%, some of the items that are more quickly brainstormed might relate to the timing of when bonuses are paid out. So for example, if you're an institution that deducts your bonus plans payments in the year of accrual, We might just take action to pay out those bonuses on March 16th instead of in February. And that would allow you to take those deductions in the year that they're paid, and ultimately then result in a higher tax benefit at a higher tax rate. Similarly, bonus depreciation, you can elect out of bonus depreciation. You can slow down the lives of your fixed asset depreciation, and that would give you the opportunity to take those in future periods at a higher rate. Prepaid expenses and deferred loan costs, those are items that our banks are commonly deducting in the year that they're paid or incurred. There's options to elect out of those on an annual basis without changing your overall method. So those are a couple additional items that could be considered. And even we have a handful of clients that have put buildings in service in 2019 or are looking to do so in 2020, for example. Those may be items where you put that on your books at a 39-year life, and then you look to later periods, say the year of enactment, to really do a cost aggregation study at a year when you'd be able to then take lower lived assets and take a lump sum deduction associated with carving up that building into lower lived assets. So a number of planning opportunities. These are just a starting list, if you will, and we'll certainly be working very closely with you if we see truly the election is going for a blue sweep and these are really imminent. These will be items that we'll definitely be talking quite a bit with you about so that we get all the benefits that we can out of changes in tax rates. With that, we'll go to our first polling question, unrelated to the topics we've covered so far, but a little change in pace for this session. Under the CARES Act, employers may defer deposits of the employer's share of Social Security tax due between late March and December, and then 50% of the amounts deferred are due by the end of December 2021, and the remaining in late 2022. Has your institution taken advantage of this FICA payroll tax deferral? And this is less of a knowledge-based question and more of a let's compare what we're doing with our peers. As a reminder, I'll give you a few moments to respond, but to participate, click the button next to the answer you choose and hit submit. And also, as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And we're getting pretty close to a high percentage responding, so we'll give it 10 more seconds or so. And we'll take a look at the results. All right, so you can see there on the screen what largely your peers have done with this opportunity for a payroll tax deferral. The outcome is largely consistent with the discussions that we've had with clients. There's probably been less excitement around this opportunity in the banking space, simply because the cost of funds are so low right now. As a firm, as we talked to other industries, especially those more impacted by COVID, we do see a larger proportion of companies in other industries responding yes, but it's interesting to see where the group is this morning. All right, so the next topic we wanted to touch on today is CECL. And this is going to be a brief discussion, but largely just a reminder that as you look to adopt CECL, if you haven't already, many of our banks are modeling out and have been modeling out what the impact is to retained earnings. We wanted to have this slide in here as a reminder that the amounts that run through retained earnings are net of the effective tax rate. It will result in a change to the deferred tax asset associated with your loan loss reserve. And so as you can see in the example, if you come up with a retained earnings impact of $100,000, in your blended tax rate's 30%. As a reminder, what will run through retained earnings is the $70,000. So this is a good item to keep in mind as you do your modeling, that the amount in retained earnings will be lower than the gross amount because of the tax effect. And that gets us to our next polling question: how will CECL impact the balance sheet of your bank? A few options there for you. And this is largely being shared, again, as a reminder that there are tax effects that go along with each of the components of CECL that will impact your deferred tax schedule. And so to the extent that it's something beyond loans, it is something that we'll be tracking additionally on the deferred income tax accounting schedules. And we're getting pretty close to all of you responding, so that's fantastic. We'll give it just a couple more seconds here. And here you can see where your peers responded. The majority of you focused on loans, but a good number still with other items on your balance sheet that will be impacted by CECL. The next planning item that we will be covering this morning are the research and development tax credits. And this has been an item that's been increasingly coming up with client discussions, so thought it made sense to spend a few minutes today talking about what types of costs ultimately qualify for the tax credits under this code section. So when you look at the research and development costs that qualify, there are certain activities that are important to describe certain costs as under the umbrella of research and development. And there's a 4-part test that's generally applied, and it looks at uncertainty, the process of experimentation, technological in nature, and qualified purpose. So the key things to be thinking about is if your institution's going out and getting a plug-and-play product, you're buying something off the shelf that plugs into your core, and you are incurring costs to, say, brand it, get it catered and set up for your customers, there's really not a lot of uncertainty to that process. Generally, that third party has already gone through the process of working through all the elements of uncertainty, working through the prototypes so that by the time you buy it off the shelf and plug it into your core, yes, there's cost incurred, but there isn't necessarily cost associated with uncertainty any further. So that's where we are more commonly seeing our banks put their innovation spend, is on those types of products. However, we are starting to hear more frequently the cost being spent on in-house development. So if you are starting to see that you're having a good amount of spend within your team for developing mobile banking apps, for developing automation, and you're going through multiple prototypes, you're building out models, you're doing simulations, you're bearing the cost of the risk that it might not work the first time through or the second time through. Those types of fact patterns lend themselves more readily to being able to take an R&D tax credit. That would be a great time to give us a call and talk further about where there may be opportunities. Likewise, we're hearing from our clients that they're going in with a handful of other institutions or a dozen institutions, and they're putting money into a partnership to do that innovation spend. That's another great opportunity where the partnership itself can be going out to get the research credit study. And if that's the case where the partnership is doing the innovation spend, then you would have the opportunity for that credit to flow back through to the bank to be claimed on Schedule K-1 that ultimately ends up on the bank's tax return. So that's another place that we are starting to see more of our banking clients put their innovation spend and ultimately get a benefit coming through. A few recent topics related to low-income housing projects I felt warranted sharing with the group. And this is because we're starting to see some of the housing projects come to the end of their life cycle. We do have a number of clients that are reaching the last few years of the credit cycle for their housing credit investments. And so the first item is to note that there is a market for selling these investments. And so if you do have opportunities to sell and you are looking for help evaluating whether that makes sense, feel free to reach out to us. Generally, you're trying to compare what they're willing to pay you for that to the remaining tax benefits that are still available. So those are items that you'll want to be mindful of if you do get approached for selling your investments. The second item to be mindful of is generally at the end of these projects' life cycle, there is a capital loss that will come through. As a reminder, capital losses can only be used to the extent that the bank has capital gains. And it does carry forward for a 5-year period. So it gives you a finite period of time that you can do planning to generate capital gains so that you can ultimately utilize the losses that are coming through. It's hard to come by capital gains. Generally, most of what you're doing is ordinary. And so there is some planning that would go into being able to fully benefit from the capital losses. Some of the common items would be if you are a bank that has a lot of FHLB dividends. In the past, redeeming FHLB stock sometimes will result in capital gains. There's some planning for end of partnership investments or selling partnership investments can sometimes generate some capital gains. So there's different strategies that can come into play, but generally there's planning involved, and always happy to be on the front end of those discussions so that you can really get the full value out of these types of investments. PPPs. For those of you who have been knee-deep in the PPP loans this year, let's talk about the tax treatment of the loan fees. Now, there's not explicit guidance on the treatment of the fees, so we really are looking at the underlying nature of the fees themselves and then looking to apply the related tax principles. So right now, there's generally 2 schools of thoughts that come into play in the tax treatment. The first is viewing these fees as being fees for service. So this treatment would align with the CARES Act description of the fees for the processing of the payments on behalf of the government. If you read the CARES Act, it really aligns with how it's written in there. If this position is taken, it really results in the recognition of the fee in relation to the services provided. So since most of the services were upfront with the loan origination efforts, it really results in the front loading of income recognition. And this would then also accelerate the income recognition over what you're doing for GAAP. So this would be the more conservative of the 2 positions that are being considered for tax purposes currently. The second thought process that goes into looking at the loan fee treatment is one that interprets that the intent of the fee is to supplement the low rate being paid by the borrower. So the thought process is that you as a bank wouldn't be making these loans at such low interest rates. So really the payment is more akin to points being paid to bring down the rate. In this interpretation, the points are treated as original issue discount for tax purposes and then recognized as an adjustment to the yield, and remaining fees then recognized upon forgiveness. So the second interpretation really does largely align with the GAAP income recognition and perhaps less effort going into the tracking of a book tax difference related to this item. So certainly consideration will be given to the broader industry interpretation as we come into filing season. But as we look at discussions in the American Bankers Association's tax committee and comparison with peer firms and such, we do see that banks across the nation are taking both of these positions, and they're both ones that are up for consideration. With that, I'm going to turn things over to my colleague, Amy Jessup.
Thank you, Kristine. That was very informative. I want to start off by introducing myself to all of you who I haven't worked with in the past. I'm Amy Jessup. I have been providing tax guidance to Moss Adams financial institution clients for 23 years. I spend a lot of my time working with clients on their tax provision planning, consulting in merger situations, and addressing information reporting and stock compensation questions. So recent tax law changes. Here we're going to take a look at the recent tax law changes that resulted from the COVID-related tax acts and provisions. As you know, the CARES Act provided the opportunity for borrowers to receive loan forbearances on their mortgages if they experienced financial hardship due to the coronavirus pandemic. As the deferred interest on these payments has likely been rolled into the loan balance, it brings to light two tax-related topics. First is that the interest related to these forbearances will generally be taxable when accrued unless it has been determined that they're not likely to be collected in the future, and that's based on an analysis done on a loan-by-loan basis. Depending on what tax rates do in the future, as Kristine discussed, this is another potential tax planning vehicle for your institution if the amounts involved are significant. The second topic is the Form 1098 reporting that is done to the borrower. The current tax guidance exists that says that the Form 1098 should only reflect the amount of interest that is actually paid during the year. So take a look at what your system's mapping is doing for the reporting of this interest on these related loans, and make sure that the correct amount is going to be reported when it comes to filing those 1098 forms. All right, that brings us to our next polling question. And we want to ask you about what your bank is experiencing. How much has the deferred interest from the CARES-related loan forbearances impacted your financial institution? Not significantly, somewhat, or overall, non-accrual interest has increased significantly, impacting you to get a gauge for how much follow-up education we should be doing on the topic. Now, hand in hand with this topic is the topic of loan losses. So this is loan losses, bad debt. It's also another topic that can be used as a planning vehicle, depending on what the tax rates do, and or the need to utilize an NOL. So unless the conformity election has been made for tax purposes, the book and tax treatment of loans don't necessarily have to follow the same timing. There have been indications, warning signs that suggest that loan losses will be significant to the industry overall in the short term. And we just wanted to remind you that there could be some tax planning related to that. Okay, I'm going to share these polling results, and it looks like there's a split between not significant and somewhat, and that's obviously probably depends on how many employees your institution has. So also on the topic of 1098 reporting, there has been a situation where borrower payments have been made by the SBA. The Form 1098 instructions address this situation in the section Payments by Third Party. So what the section says is that the Form 1098 shouldn't include a mortgage interest received from a governmental unit or agency such as an SBA. And the instructions also address the situation where if another agency is making the payment, such as a state agency. So that's a good resource. And then also as a reminder on that, double check your systems and make sure that the correct amount is going to be reported on the 1098 if you have any loans where this applies. All right, so we're going to discuss the COVID-related payroll credits, sorry. There are two types. There's the ERC, the Employee Retention Credit, and the sick leave and paid family leave credits. The IRS has a very helpful chart on their website to help taxpayers understand what they're eligible to receive, and I've included that link in the slide. So we haven't seen too many banks take the employee retention credit because banks are essential businesses and the ERC doesn't apply to essential businesses. However, some branches may qualify if there have been more restricted governmental orders that apply to those branch locations. So that's going to be very situational. And there is, some uncertainty in that area, I have to say. The sick leave, paid family leave credit are generally applicable related to qualified wages if there's less than 500 employees at your institution. So again, these are both payroll tax credits, and they're taken on the quarterly payroll filings on Form 941. IRS Announcement 2020-12. So this falls under the category of problem solved before you even likely knew it was a problem. So kudos to the ABA for getting the IRS to address this early. So what this announcement says is that Form 1099-C, cancellation of debt, are not required to be filed related to PPP forgiven loans. In fact, the IRS wants lenders to know that they should not be provided to the IRS or to borrowers at all. And the idea behind this is that reporting would create a bunch of confusion and also an administrative burden to the lenders. Due to COVID, and maybe just in general, given the advancements of technology in the global work environment, the mobile workforce is a hot topic as of late. Over the past several years, laws have been initiated that have factored regarding setting a safe harbor. And the safe harbor would be if an employee is in a state more than 30 days out of a year. And what this legislation is trying to accomplish is to provide some relief to taxpayers who have employees that work in different states from time to time without creating the need to address employee state withholding and workers' comp in every situation. So unfortunately, the current act has a low chance of being enacted, but it will get reintroduced in the future, and we'll see what happens. In the meantime, some taxpayers are kind of looking to this and using it as their internal policy. And although there's no support, to back up this policy, it provides some level of administrative relief. When dealing with states, each state has different requirements and every situation is different. So reach out with your specific questions and get input from your state and local tax team. Some states have addressed the fact that working from home has become more commonplace, and they have provided relief or some relaxed rules during these times. Brings us to the next polling question. How many states does your financial institution file in? As a reminder, for those of you that would like a copy of today's slide deck, you can download them from the folder that says Slide Deck and Handouts, the right of the slide view, and we will also be sending those slides out via email after the webcast. Also, once you have completed all of the CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. Okay, so I'm going to share the results with you. It looks like we're still getting some input, so we're going to wait a minute, but it looks like over 50% file in home state only, and there's quite a few that file in 2 to 4 states. So there we are. Okay, so we're going to move into just a jumble of recent tax guidance and other items of interest. So a little bit of this and a little bit of that. Form 99 NEC. NEC is non-employee compensation. So this information, the information that needs to go on this form used to be reported on Form 1099 miscellaneous in box 7 as non-employee compensation. Now it needs to go on this new form, 1099 NEC, and is due by January 31 to both the recipient and the IRS. So it has the same due dates as an employee W-2. This is now where bank director fees will be reported. Take the time to update your systems and make sure that this transition to this new form will go smoothly, because January 31, 2021 is right around the corner, and that's when your bank will need to be filing these forms. Okay, trends that we are seeing on both the IRS and the state side are, in general, delayed response times. There's notices being generated that are not correct. And those are generally related to payments from the COVID-related due date deferrals. And those ones are getting cleared up. Some other more technical issues are also getting cleared up, but it takes some time. The IRS is sending out letters that acknowledge receipt of notice responses, but that they need additional time to process it. This slide is not bank related, but it is good information for you to have because you might know of someone that can benefit from it. If an individual, a spouse, a dependent has been diagnosed with a coronavirus or has experienced adverse financial consequences as a result of being quarantined or due to lack of child care due to the virus, then there is some relief related to retirement plan distributions. So through the end of the year, up to $100,000 of retirement plan distributions can be taken without creating a penalty. On top of that, the tax due on those qualified distributions can be paid out over 3 years. So 1/3 is going to be due with each of the tax returns for 2020 through 2022. On a completely different topic, Oregon has issued guidance to financial institutions on how revenue will be sourced related to the corporate activity tax. This is the new Oregon CAT tax. So there's no big shakeup with these rules, but it's good to see them in print to confirm how we already thought it was going to be treated. For purposes of the Oregon CAT, interest and dividends on loans secured by real property located within Oregon are sourced to Oregon. So that in general follows the market-based rule approach. So if that amount exceeds $1 million, then a CAT tax return will need to be filed. The CAT rate is 0.57%. So on a side note, it's always a good idea to have an understanding about how much interest is being generated from out-of-state loans. If you don't already have a report that can produce this information, I recommend you getting that on somebody's to-do list. A reminder that NOL guidance has gone through some recent changes. NOLs for 2018 to 2020 can be carried back 5 years and forward indefinitely. The utilization of the NOLs that are carried forward can be used 100% to offset 2020 income, but starting in 2021, only 80% of income can be offset. With regard to dividends paid on unvested restricted stock, we want to remind you of the information reporting rules related to those dividends. Any employee who has unvested restricted stock and has not made an 83B election related to those shares will have compensation income related to those dividends. The dividends are reportable on an employee's W-2, and they will be subject to income and payroll tax withholding. Because of this treatment, the bank gets to take a tax deduction related to that compensation, and that's going to result in a favorable per item adjustment. Now, in the situation where an 83B election has been made, the dividend character is retained, and the dividend is reported on Form 1099 EID. So please note there is a typo on this page, and that the form should be a 1099 DIV related to that reporting. On the topic of LIBOR replacement, the IRS has recently issued guidance saying that there is that if there is a modification to a contract that has been updated for the purposes of updating the terms previously referenced to the LIBOR, then that event, the modification of the contract, does not create a sale or exchange event for tax purposes. This is a relief. It's another one of those problems that got fixed early on before it created a problem, so that every time you renegotiate a contract in order to update that LIBOR reference, it's not creating, a sale for tax purposes. Meals and entertainment. Final rules came out just a couple days ago, but they weren't really, there weren't any really significant changes from the proposed guidance. So just quickly, we'll just remind everybody that the 50% limitation applies to all food, so that even includes the break room items. The only exception to the 50% deductibility of food is for recreational activities for the benefit of employees, such as holiday events or summer picnics, or amounts related to compensation. So, and then also as a reminder, all entertainment is not deductible. But entertainment doesn't include food if it can be broken out separately from the entertainment costs. So if you have an event that includes entertainment and meals, then if it is separately identified and you can separate the cost from each, you can deduct the meals at 50% and deduct the entertainment at 0%. 100% non-deductible. So entertainment also includes dues or fees to social, athletic, or sporting club events and organizations. All right, before we go, we want to encourage you to visit our website. We have great content, and if you download the slides, you can find all the hyperlinks included here within the PDF. We have, here's an example of the things that you can locate through our website. We also are happy to address any of your questions. You can reach out to us. All right, now we're going to take your questions. And I do see that we had a question on the dividends related to unvested stock. And the answer to that would be that relates to the cash dividends. So thank you for having me clarify that.
Amy, it looks like we have one other question coming through related to recreational activities. Birthday cake served at workplace is a common item. Can you speak to your thoughts on that?
Yeah, I think it falls under a gray area, so any position has to be taken on that depending on the risk involved. I think there is a position that can be taken that it is one of those events that falls within the benefit of the employees. But because it's not strictly identified in the guidance, there's no guarantee. So, like I said, it's a gray area.
One other question for you, Amy. You talked about the employee retention credits and how you've seen a finite number of examples within the banking space. Can you speak to a couple that you have seen our clients take advantage of and what their specific facts were that allowed them to essentially take advantage of the credit, whereas many of our banking clients cannot?
Right. So it related to branch locations that the coronavirus-related rules regulating the activity for that branch were so restrictive that it essentially created a situation where that branch was not able to operate, or the fact that employees were not able to perform because of childcare. So that would be one situation where I've seen that.
Right. That's consistent with what I've seen as well. Is there's been a few government agency requirements where maybe a branch is only allowed to have 6 people in the branch instead of the normal dozen. And so by governmental order, there's a limitation on who can be in there. And that is in contrast to the bank making the decision themselves to limit the number of people in the branch. And if I'm reflecting on some of the conversations we've had with clients, a lot of it really comes back to which are the decisions that are being made by your own preference for safety as opposed to which are government mandated, which really aligns back to what the employee retention credit points to.
Yeah, absolutely.
With that, it looks like we've answered your questions, so certainly feel free to reach out to us for any unanswered questions. But I will go ahead and turn it over to Amy Pendergrass to close things out for us.
All right. Thank you, Kristine and Amy, for a great presentation today. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us. We hope you'll join us again next time.